The Russian Land of Fire. To understand oil prices and production, you have to understand the importance of oil in Russia. The modern oil industry was born in an area known as the Land of Fire in the Russian Empire. You see, back in 1846, the world's first modern oil well was drilled on the Ashvaron Peninsula near modern-day Baku, which is in Azerbaijan. 13 years this well happened before Drake drilled the famous Titusville well in the USA. Called the Bibi Heibat oil field, it laid the foundation on the newly found black gold. And by 1899, as Tsar Nicholas was in his first decade of rule over the Russian Empire, Azerbaijan, which was in the Russian Empire, led the world in production of oil, producing half of the world's oil that year. Little did Nicholas II understand how oil pricing and dynamics would lead to the end of his 300-plus year rule of his family dynasty over the Russian Empire. By the turn of the 20th century, the Russian Empire was the world's largest oil producer. The Russian oil field Baku alone was producing 230,000 barrels of oil per day, while all of the U.S. at the same time was producing about 183,000 barrels of oil per day. Nicholas II found out what happened firsthand when the boom-bust cyclicality of the oil market and wasn't prepared for the eventual 1917 revolution, where he and his family were killed and the communists took over, and the subsequent nationalization of its oil companies. The interesting thing about the revolution of 1917 that nobody talks about is that foreign capital did not leave Russia. The sanctions that are happening today did not happen in 1917. Out were the Rothschilds and the Nobels who developed and funded the Baku oil fields, and in were the Rockefellers with Standard Oil of New York, which later became Mobil, and then ExxonMobil, and then just Exxon. In the economic post-Second World War boom, large oil deposits were discovered in Russia. The increase in Soviet oil exports led to a decline in world oil prices, and one of the main reasons OPEC, the Organization of Petroleum Exporting Countries, was formed in 1960. The chart you're looking at right now shows Russian crude oil production since 1960. Focus on that little red circle there. That's the low, and that's when the USSR collapsed in the early 90s. To this day, Russia remains one of the largest and most powerful oil players in the world. As the Russians invaded Ukraine, sanctions began to pile up on Russia and Russian banks. It is estimated that over 3 million barrels per day of Russian oil crude could be impacted by these sanctions. This, in turn, has fanned the flames on an already undersupplied oil market and sent the price of crude oil skyrocketing back towards all-time highs. Below is a chart for Brent crude oil, which is the most widely used international benchmark for pricing crude oil. While the price of global crude oil has soared, Russian oil prices have actually cratered. The key Russian benchmark for crude oil, known as the Ural, has fallen to a record discount. That's the difference between what the Ural gets per barrel and the Brent crude oil. That's the chart you're looking at right now. Contrary to the Ural discount to Brent, which is at or near record lows, share prices of oil stocks are soaring to levels unseen in years. Whether you're a small-time junior oil producer or Exxon, all companies are reaping the rewards. The XOP ETF, which is the oil basket of North American oil producers, is up 350% since April 1st, 2020, far outpacing the S&P 500 and the NASDAQ on a post-COVID recovery basis. That's the chart you're looking at right now. But here's an interesting thing. A potential big trend you're going to see now is oil producers going unhedged, as companies will begin to believe that high oil prices are here to stay. It is common for oil producers to lock in fixed prices for some or all of their oil production in the coming 3 to 24 months. In the United States, 30 to 40% of all oil is hedged for 2022. This strategy works well for the bankers, which provide loans to the oil companies based on these locked-in prices. It's all about reducing your risk to exposure. However, when prices surprise to the upside or downside in a major way like they have recently, it negatively impacts the oil producer, especially so when oil companies bet on prices staying within a forecasted range and sell options to earn additional income, those damn derivatives, weapons of financial mass destruction. This is known as a three-way collar and has penalized the oil industry before when the prices cratered from $100 per barrel to $30 per barrel in a span of 18 months. Now, with prices rising above expected prices, many oil companies have sold calls. If you have sold an oil call option, you are obligated to provide the buyer with an oil at that specific price. And if you sold an oil call option at 75 per barrel and the price of oil is now 100, you're out 25 minus any premium you sold the call option for. If you're going to be a serious oil investor, you need to have a firm grasp on your company's hedging strategy, or else you could be way base off. It could lead to projecting far higher cash flows and share prices than what is reported. Deep dive analysis, extensive due diligence, and outside-the-box thinking are what differentiate Catoosa Research from the rest of the pack. Natural resources have been my sole focus for 20 years. If you're looking to give your portfolio that next leg up, pay attention. Stay safe. Subscribe to the KRO, which is a Catoosa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.